What is up? Good morning, people. Hope you're all doing well. Capital Preservation Friday, here we go. Some non-farm payroll stuff came out this morning. A lot of eyes were on jobs data as this market seemingly continuously is quote unquote crashing here. We're down about 7% on the SPY from the highs, and everyone's losing their asses. But like I've talked about before, we haven't necessarily seen extreme fear, quote unquote, and extremely oversold indicators. So we could see a little more downside. The SPY is going to fight for its life around this 200-day moving average. I think we are fairly close, but right now, as intraday movement sees it, and as order flow would tell, is just sell the rally. Every freaking buyer that comes in gets hammered with an offer, and I'm not seeing any potential for this buy side in the most recent past here in this most recent information. Things can flip on a dime. We saw last Friday a very strong pop, but as the old saying goes, markets don't bottom on a Friday. So we'll see how that does shape up overall, but I am a little skeptical realistically as things are still holding out on the offer. I think we're pretty close, but we saw this jobs data here. Let me just move this aside. The jobs data that came out, we have a lot of geopolitical concerns. We got Trump, Canada, US, Mexico, everyone talking tariffs. We recently got an executive order on Canada and Mexico tariffs reduced. The duty rate for non-US MCA compliant potage to 10% from 25%. But the jobs numbers were the main piece of information, if you will, from this morning that a lot of traders and investors were looking at, right? These data points are important for the current economic standing as well as the Federal Reserve's next move, right? The Fed with all this downside momentum and with these potential tail risks that are coming about, it seems like there is going to be some kind of pressure to put on the Fed to actually start cutting rates again. So in the backdrop to global trade uncertainty, investors right today are going to be watching the non-farm payrolls. We saw them come out about half an hour ago. And right, remember Jerome Powell, Federal Reserve Chair Jerome Powell is doing a speech in the afternoon. Consumer and business confidence have already taken a hit, and some view today's jobs report as the final snapshot of the labor market before it reflects significant impact on the Trump administration's recent policies. We saw that the jobs numbers here on the screen. Financial Juice, shout out them. This is the site that I'm on. The U.S. non-farm payrolls, they were expected at 160,000. Previous was 140, and the actual number is softer than expected, 151,000. The U.S. unemployment rate rose to 4.1% from 4%, and we have some other figures here. The average average hourly earnings, 0.3% versus 0.3. So today we have Fed's Bowman that speaks at 10:15. We've got Fed's Williams that speaks at 10:45. We've got Fed's Kugler that speaks at 12:20 Eastern time, and then we have Jerome Powell that comes on at 12:30 Eastern time, with Kugler coming on again at 1 p.m. We have some executive orders to be signed by Trump at 2:30 p.m. Eastern. We got Trump remarks at 3 p.m. Eastern today. And this day is full of news. So, like I said, the jobs, the economists were expecting 160,000 jobs to be added to the U.S. economy in February, up modestly from 143,000 in January the prior month. Unemployment, we saw that we got an uptick from those things. And we have some information from some analysts here with, they were expecting lower February readings, closer to 145, 150, suggesting that data combined with recent indicators suggest a hiring hesitancy among employers as they assess the economic climate ahead. Analysts also say that the Trump administration efforts to streamline the federal government, including its effect on the private sector, could erase about a quarter of all jobs created last year by the end of 2025, which is pretty crazy. Private job sector growth already cooled pretty aggressively in February. We can see the private payrolls, right? Not something necessarily too drastic under the expected area, but 140,000 versus 147,000 expected. So for March and beyond, 4 government-related factors will stand out: federal layoffs, spending cuts, that will lead the staff cuts at the government contractors, immigration policies, and tariffs. But some government layoffs and spending cuts are being challenged in court, and tariffs have been delayed again. Given some of the volatility, we can see them keep getting retracted and pushed down the line to kind of cool things off. So people are starting to compare the Trump administration's first round of kind of trade war tariffs in 2018-19 to what's going on right now in relation to the S&P 500. And we're seeing a very similar pattern with the most recent downside momentum that's coming through. And a lot of traders expecting a rally after more intensive kind of back and forth with these tariffs. Now, as I'm looking at this, it's pretty bearish, right? Like, yeah, I do like upside. I do like momentum swings to the upside. I like to swing to the upside, but I can't be an idiot and look at this blindly and say, no, we're going up. It's not the fact, right? We have aggressive selling that persists. We've undercut most recent weekly lows. We're probably going to undercut them again. The Nasdaq's looking towards 19K and even lower, right? The 19,000 handle. I have an area of an extreme low between 19,400 and 19,500. If we see that, we see that. But that's probably where I'm going to start getting more aggressive on the swings to the long side. Otherwise, as I'm looking at this, I can't keep buying these 1% pullbacks. We're off the tops on the SPY about 7%, right? It's not that much. We haven't seen crazy signs of oversold indication just yet. The triple Qs are down 10%, fair enough, right? They still have potential momentum lower. Until we start actually accepting into distributions higher, it's hard to be like, boom, this is the low, keep buying lower and lower. You're seeing the aggression of the sell side. And as I'm looking at this today on the S&P, I might have to whip out a bigger chart here because I don't really have that much data underneath. But we have an area that sticks out at 57.20, very, very close to where we're at right now. If we lose that, we start accepting lower, and there's probably a 50, 70 point slip lower if we actually accept under that 5,700 area. So a lot to think about here in relation to this price action movement. And I wouldn't necessarily be one to look at this and be like, it's time to buy everything, right? It's too oversold. It's down too much. Sell rallies realistically, right? You're below a lot of these auctions. If we lose 57.20 on the SPOOs today, I'm looking for more downside. The only thing that would tell me it's time to flip this thing long, it realistically is going to be a bit above 58.05, 58.10, right? It could start above 57.75, but again, it's a pretty long way away. I don't want to continuously try to find this bottom. If it accepts higher, it accepts higher. And then we'll go from there. I've already taken pretty much my trade for the day, and we'll see how these things shape up. But I'd be very cautious trying to pinpoint these lows constantly over and over again. There's a good potential if we swing back up, but the thing is the probability is fairly low. So